Welcome back, everybody, for another deep dive.
Yeah.
This time, we're going to be exploring risk, particularly as it relates to investments.
Okay.
And, you think about it,
Yeah.
seems pretty straightforward.
Right.
Really highlight how often even experts kind of misunderstand it.
Yeah.
And, of course, that can lead to some pretty bad decisions.
That's sure.
So we're going to be looking at a case study,
Okay.
long-term capital management, and it's a hedge fund.
Yeah.
A hedge fund that was packed with Nobel Prize winners.
Wow.
Wall Street hotshots.
Interesting.
They thought they had risk all figured out.
Until they didn't.
So by the end of this deep dive,
Okay.
you're going to have
Okay.
a much clearer,
Okay.
more practical way to think about risk
Got it.
in any area of your life, not just investments.
That's great.
I'm excited to dive in. I think it's fascinating how much our understanding of risk really shapes the choices we make,
It really does.
often without us even realizing it. So let's start unpacking
Okay.
what we think we know about risk.
Sure.
That most of us tend to define it pretty vaguely.
I see.
We talk about probabilities,
Yeah. Probability.
market swings,
Mm-hmm.
those black swan events.
Right.
But, do those really help us make decisions?
Well, that's the problem, right?
Yeah.
All those terms,
Think
they
about-
sound
Are
important.
important, yeah.
Yeah.
But they don't give us a concrete way to
They don't really give us a concrete way to measure risk.
measure.
You
right.
know, it's like saying a stock is risky,
Oh, totally.
but you're not explaining what that actually means for your money.
Oh, totally.
You know?
Yeah.
If you can't define it clearly,
Right.
you can't measure it,
Right.
and then informed decisions,
Become nearly impossible.
very difficult.
Yeah, like trying to navigate a maze blindfolded.
I like that.
Right.
Yeah.
And speaking of navigating blindly,
Okay.
talks about the 2018
Yeah.
P2P lending crash in China
Oh, yeah.
as a perfect example of this.
Oh, wow.
Thousands of investors lost their savings practically overnight
Really?
because they didn't truly grasp the risks involved. So I thought what was fascinating there is the psychology at play.
Oh, interesting.
How many investors just got caught up in the allure of high returns with seemingly low risk? They were relying on what their friends were doing
Oh.
or even celebrity endorsements
Got it.
instead of really understanding what they were getting into.
Wow. That's really interesting.
The classic too good to be true
Yeah. Too good to be true.
scenario.
Right.
And it's so tempting,
It is.
especially when it comes to those around us,
Yeah,
people we admire. But when it comes to risk, that can be really, really dangerous.
for sure.
So let's shift gears a little bit.
Okay.
We're going to talk about long-term capital management,
Okay.
or ATCM.
LTCM. Got it.
This is where things get really, really interesting.
Okay.
So this hedge fund
Yeah.
was founded by John Meriwether,
John Meriwether.
who was a Wall Street superstar, and his goal was audacious:
Interesting.
to measure and control risk
Okay.
using these complex mathematical models.
So this is a smart guy
Yeah.
using algorithms.
Yeah.
Got it.
But it wasn't just him.
Okay.
He assembled this team
Oh, wow.
of financial rock stars.
Okay.
We're talking Nobel laureates,
Wait.
former vice chair of the Fed, top
They
academics.
had all the brain power.
It was like a brain trust designed to outsmart the market.
Very interesting.
And they had serious brain power.
Yeah.
And at first,
Yeah.
it seemed like they'd actually cracked the code.
They cracked the code.
They were raking in returns
Yeah,
of
yeah.
21%
21%.
in their first 10 months,
Really?
with very little volatility.
Wow.
So it seemed like their formulas actually worked.
Well, their early success would make it seem that way.
Right.
But then 1998 came along,
Oh,
and the Russian financial crisis,
right.
the ruble collapsed.
Wow.
The government defaulted on its debt.
Oh, wow.
A true black swan event
Yeah.
that sent shockwaves through the global financial system.
So how did this impact LTCM?
Well,
Did their fancy models account for something like this?
no, they didn't.
Really?
You see, LTCM had heavily leveraged positions betting on the stability of the ruble.
Oh, wow.
And when it crashed, their entire system imploded.
Oh.
Within a week, they were on the brink of bankruptcy.
Oh, my.
6
Yeah.
were 7 sigma event.
Wow.
Statistically speaking,
Yeah.
something so improbable it should never happen.
So even with all those brilliant minds
Yeah.
and those sophisticated algorithms,
Right.
they couldn't predict or prepare for this level of risk.
They couldn't.
That's a pretty stark lesson.
Yeah, it is.
What do you think this tells us about our ability to control risk?
It's humbling,
Yeah.
especially in something as complex as the financial markets.
Yeah.
It shows that even the smartest people can be blindsided by the unexpected.
Okay.
This wasn't just bad luck.
Yeah.
It highlights a fundamental flaw
Okay.
in how we often approach risk.
Okay, I'm all ears. What's the flaw?
Well, we were talking about how LTCM's collapse
Ice.
exposed this flaw in how we approach risk.
Yeah, so are you saying they were overconfident?
That's part of it.
Okay.
We crave certainty, especially when we're dealing with something like risk, which is so intangible and impactful.
Yeah, we want to be able to control it.
We want to believe we can predict it,
Yeah,
control it,
Right.
but the reality is we can't.
right. Not fully anyway.
Not fully, no.
So what do we do then?
Right.
If these complex models and algorithms built by these geniuses
Yeah.
aren't the answer?
Kind of an interesting shift in perspective.
Okay.
Instead of obsessing over predicting risk,
Okay.
it suggests that we should focus on understanding the potential consequences.
That sounds a lot less stressful, actually.
It does, doesn't it?
But how do we actually do that?
Well, it boils down to
Yeah.
a simple
Okay.
yet powerful question.
Oh,
If this loses 50% of its value,
okay.
can I understand why?
Okay.
And do I know what to do?
Okay, so break that down for me.
Yeah.
Why 50%?
Well, it's not really about that specific number.
Okay.
It's more about preparing for a significant downturn.
Okay.
And if you look back historically,
Yeah.
substantial drops are actually pretty common
Right.
across asset classes.
Okay.
So it's a useful benchmark
Yeah.
to force us to confront
Okay.
that potential downside.
So it's not about avoiding loss altogether,
No,
because that's impossible.
that's impossible.
It's about thinking through what you would do
Exactly.
if a major loss happened.
Exactly.
Okay.
So let's go back to that example of the
Right.
CSI 300 index fund in China.
Okay.
You invest in that,
Yeah.
and it suddenly loses half its value.
Okay.
Could
Right.
you understand the possible causes for that?
Well, I mean, I'm thinking a major economic downturn in China would probably be a big factor.
Sure.
But even thinking about it more,
Yeah.
there are so many things
There are a lot of things.
that could contribute to that.
Absolutely.
You know, maybe there are changes in government policies.
You've got it.
Maybe there's some unexpected global event.
Mm-hmm. Mm-hmm.
I hadn't really considered those things before.
Right. And that's just the macro level.
Oh, wow.
You also have company-specific risks to think about.
Oh, right.
Maybe some of the companies in the index are facing financial troubles.
Yeah.
Or they get disrupted by new technologies.
Wow.
It's very multi-layered,
Yeah.
and it can feel overwhelming.
It really makes you realize how much is outside your control
It does.
as an investor.
As an investor, yeah.
So let's say I thought through all of that.
Okay.
And hypothetically, my investment
Yeah.
in this CSI 300 index fund
Yeah.
takes a nosedive.
It tanks.
Oh, yeah. What now?
Right.
What are my options?
Well, this is where it becomes personal.
Okay.
There's no right or wrong answer.
Right.
It really depends on your individual circumstances,
Yeah.
your risk tolerance, your overall investment goals.
I'm guessing for some, holding steady is a valid option.
It is.
You know, if you believe in the long-term potential,
Right.
you just ride it out.
You weather the storm, wait for it to recover.
Yeah.
Some people might see it as an opportunity to buy more at a lower price.
Right.
If they have the means to do so.
What about those that can't afford to wait for a rebound? Maybe they need access to those funds sooner rather than later.
Right. They might have a predetermined exit point.
Oh, okay.
They've already thought about, okay, if it hits this level,
Yeah.
I'm out,
Yeah.
even if it means taking a loss.
So, yeah.
Maybe they plan to gradually reduce their holdings as the market declines.
Interesting.
The key is having thought about it beforehand.
Right.
So you're not making emotional decisions in the heat of the moment.
Yeah, it's easy to say don't panic,
It is.
but when you see your portfolio dropping like 50%,
Oh, yeah.
it's hard to stay rational.
It is. Our instincts
Yeah.
often push us towards that panic selling, which can lock in those losses
Right.
and really derail your long-term goals.
So this approach is all about taking emotions out of the equation as much as possible
As much as possible.
and having a plan.
Having a plan, yeah.
I love how we've been talking about this in terms of financial risk,
Yeah.
but I'm curious
Hmm.
how this applies to other areas of life as well.
That's where it gets really interesting.
Okay.
This consequences over prediction framework
Yeah.
has applications far beyond investing.
Okay.
Think about a career change, for example.
Oh, that's a big one.
That's a big one.
Yeah,
Often comes with its own risks.
for sure.
You could use the same framework to evaluate a potential career move.
Okay.
What are the potential downsides of leaving your current job?
Right.
What's the worst case scenario in this new role?
Yeah.
What steps can you take to mitigate those risks?
So it's not about blindly leaping into the unknown.
No.
It's about being proactive,
Exactly.
thinking through the consequences,
Being proactive.
creating a plan.
Absolutely.
Okay.
And I think that's a powerful takeaway
Yeah.
from this whole discussion.
Yeah.
Risk is inherent in life.
Right.
We can't eliminate it,
Right.
but by understanding those potential consequences,
Yeah.
we can navigate those uncertainties
Right.
with more confidence.
This has really been eye-opening.
Mm-hmm.
This feels like a much more practical and empowering
It is.
way to think about risk.
Yeah,
But let's be honest.
sure.
This is all a bit theoretical.
Yeah.
How do we actually put this into practice?
That's where we'll pick things up in part 3.
Okay.
We'll get a bit more personal.
Okay.
And we'll explore how we can apply these insights
Got it.
to our own individual decisions and experiences.
Risk and consequences.
It's been a good one.
It has. It really has. We've
Yeah.
covered so much ground,
Yeah.
from these high-stakes hedge funds
Yeah.
to the psychology of risk perception.
Right.
It's been fascinating to explore how this concept of risk
Yeah.
permeates so many different aspects of our lives.
It really does.
But now it's time to get a little more personal.
Okay.
We hinted at the end of part 2 that we'd be diving into some self-reflection.
Mm-hmm.
And I, for one, am ready to put all this knowledge into practice. I think the source material gives us the perfect springboard for this.
Yeah.
Remember that thought-provoking question
I do, yeah?
that I posed right at the very end
I do.
about reflecting on a past investment loss?
Yeah. It's a powerful one.
It is.
It might stir up some uncomfortable feelings,
It might.
but those feelings are valuable
Oh, yeah.
because they can lead to some real insight.
For sure. For sure.
Yeah.
So for anyone just joining us, or if you just need a refresher,
Yeah.
here's the question. What was the situation the last time you suffered a relatively large loss in your investment portfolio? What risk considerations did you make beforehand? And when you suffered a large loss, did you have a way to deal with it?
That's one.
It encourages us to look back at our own experiences,
Exactly.
ask ourselves some tough questions.
Sometimes those are the best ones.
So I'm going to be brave here
Good for you.
and share a personal story.
Oh,
This might be a little bit embarrassing.
I'm sure it's going to be insightful.
I hope so.
Yeah.
I think it really illustrates how easy it is
Yeah.
to fall into these common risk traps.
Uh-huh.
So a few years back,
Okay.
I got caught up in all the hype around a certain cryptocurrency.
Ah, okay.
Everyone was talking about it.
Yeah.
The price was skyrocketing.
I remember those days.
Felt like I was missing out
Oh, yeah.
on this huge opportunity.
FOMO?
The FOMO was real.
Big time.
It was strong.
That's a powerful motivator.
So powerful.
Yeah.
I did some research,
Okay.
but honestly, not nearly enough.
Right.
And I kind of let my emotions get the better of me.
It happens.
I convinced myself this was a sure thing.
Oh, yeah.
Long story short, I invested a sizable chunk of my savings.
Yeah.
How'd that turn out?
Yeah, I'm anticipating.
Not great.
Okay.
You can probably guess where this is going.
Yeah.
The market took a nosedive.
Oh, no.
I lost a big chunk of that investment.
Oh,
It was a tough pill to swallow,
it is.
and it definitely took a toll on my confidence as
Yeah.
an investor.
As they
You learn more from your failures.
than your successes.
Yeah.
And this experience was painful.
Right.
It really drove home some of these key points
It did.
we've been discussing in this deep dive.
Absolutely.
So looking back, what do you think were the biggest contributing factors
To that loss.
to that loss?
Yeah.
Biggest mistake I made was not fully understanding the risks involved.
I see.
Got so caught up in the potential upside,
Yeah, the excitement.
the excitement of it all,
Right.
completely overlooked the downside,
Right.
had zero plan for what I would do if things went south.
And that's the danger, right?
Yeah.
You chase the hype,
Yeah.
you ignore the consequences.
Yeah.
It's like jumping out of a plane without a parachute.
Is it?
You might enjoy the free fall for a while,
Yeah.
but the landing is going to be rough.
That is a great analogy.
Yeah.
No investment is a sure thing.
No.
And having a plan
Right.
for handling potential losses.
Is just as important as identifying those potential gains.
Absolutely. That's a fantastic insight.
Yeah.
And it really aligns with this whole framework we've been exploring.
Right.
It's about shifting our mindset from trying to predict the unpredictable to preparing for a range of outcomes.
Right. Even the negative ones.
Even the negative ones, yeah.
Now, I'm curious to hear from our listeners.
Me too.
Have you ever experienced a similar situation?
Right.
A time when you made an investment decision,
Yeah.
maybe not fully understanding the risks.
Maybe got caught up in the hype.
the hype.
Yeah.
Maybe didn't have a plan for dealing with those potential losses.
Yeah. What did you learn from that?
What did you learn from that experience?
Take a moment to reflect on that.
Yeah.
Think back to a time
Yeah.
when you experienced a significant loss.
Whether it was financial, professional, or even personal.
Absolutely.
What risk assessments did you make beforehand?
Right. How did you handle the fallout?
These are tough questions.
They are.
But they're important.
They are.
By reflecting on them,
Yeah.
we can identify patterns in our own decision-making
Absolutely.
and develop strategies for approaching risk in a more mindful way,
And an informed way.
in a more informed way.
Yeah.
This isn't about dwelling on past mistakes
No, not at all.
or beating ourselves up.
It's about learning.
About learning.
And growing.
Yeah.
And using those lessons to make better decisions moving forward.
Recognizing that risk is an inherent part of life.
It is.
It's in every choice we make,
Every action we take.
every action we take.
Yeah, it's what makes life interesting. It's what
Yeah.
makes life challenging.
Challenging.
And ultimately rewarding.
Without risk, there's no growth,
No growth.
no innovation,
No innovation.
no progress.
No progress.
So as we wrap up this deep dive on risk and consequences,
Yeah.
we encourage you to keep exploring,
Keep questioning.
keep pushing the boundaries of your understanding.
Remember,
Remember,
the best way to manage risk,
is not to avoid it
but to face it head on.
with a clear head
With a clear head.
and a well thought out plan.
And sometimes
Yeah.
the greatest lessons come from our mistakes.
Thank you for joining us on this journey.
It's been a good one.
It has.
Yeah.
Until next time,
Stay curious
stay informed.
and embrace the uncertainty.